loan is less than $10,000, then no tax update. Capital gains only come into play if it is a capital asset. One Bitcoin is worth $39,984.70 in US dollars. Ask Roger. Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. Hey everyone, I'm Roger Herring. I am the Investor's Accountant, and hey, welcome to another edition of Ask Roger. We talk around here about wealth. We talk about real estate. We talk about tax reduction. We talk about tax elimination. We talk about wealth multiplication. All of those things. People hit me with questions all the time, and here we are for another round. So the question of the day is, Roger, what should I do before I start investing? Really good question, and I wish more people asked it, because a lot of times folks come to me after they've started instead of when they're getting ready to start. So here we go. There are three things that you need to make sure you do before you begin investing. You need to, 1, count the cost. 2, eliminate reductive debt. 3, build up cash reserves. So let's start with counting the cost. What do I mean? I need to know how much money it's going to take to go into business. But more importantly, I need to know how much money I need to live, because now I'm going to have to divert money to the business to get things going. Now, if I've got a W-2 job, great, because I can take my W-2 job and start my real estate business as what? A side hustle. And I can leverage my W-2 to be able to get loans to go out and do those wholesales or flips or to buy that rental property. But if I don't have a job, if I plan to quit, or if I have been laid off, I may have a problem here, because now the overhead of my business is going to include all the money I spend every month, meaning my personal burn. Yeah, you have to eat, guys. And in small business, either the business starves or you starve. So I strongly recommend don't quit your day job. Do this as a side hustle to begin with and then grow it. All right. Second thing to do, eliminate reductive debt. Now, reductive debt is what Robert Kiyosaki referred to as bad debt. Okay, that's money that that is debt that takes money out of your pocket. We're not talking about leverage where we're using other people's money to acquire income producing assets. I'm for that all day long. If you're going to build a portfolio, you either need a lot of leverage or a whole lot of money. And I would rather have a whole lot of leverage and not tie up a whole lot of money, because the idea is to have a little bit of my money and a lot of other people's money and control a whole lot of real estate. Anyway, back to reductive debt. What is reductive debt? Where does it come from? You know what? Credit cards are the number one culprit, but very closely behind that are high interest student loans. They will eat you alive. So how do we get rid of them? First off, why do we want to get rid of them? So we have a better credit score. We want our credit score to do what? Yeah, this way, up. By eliminating that debt, we're going to send our credit score up, which is going to lower interest rates when we borrow money and give us a better chance to be approved for the amount of money that we need. All right, how do we do it? I have seen cases of a little bit of reductive debt, and I have seen bloody nightmares. If you got the bloody nightmare, meaning a lot of debt and a lot of high interest, you should strongly consider using the equity in your home. Okay, that will eliminate that. And for the most part, what we're doing is we're trading short-term debt for long-term debt. But in the eyes of the credit bureau, our score is going up. Okay, second option, if it's $50,000 or less, you can take a loan from your 401k if you have one. The law says you can take the lesser of 50% of the vested balance of your 401k
or 50 grand. All right. So you take the 50 grand and you pay off, let's say you paid off student loan debt, and that debt was between 20 and 30% interest. All right. You can pay off the $50,000 of that, pay off the credit card debt, all this high interest stuff. And guess what? The 401k loan does not go on your credit report. That's right. It doesn't go there. So in the eyes of the credit bureau, you've just eliminated that debt and you have a whole different picture financially, according to them. Now, you got 5 years to pay that back, but you're going to pay it back at probably prime plus 1 or prime plus 2, depending on who the administrator is. So that's a much better deal. $50,000 at 8% versus $50,000 at 30%. Yeah, you're going to look a whole lot better. Now, the third option is called the debt snowball. Now, Dave Ramsey introduced this, and I love the concept of the debt snowball. What you do is you list all your debts from greatest to least. You're going to pay the minimum payments on everything but the least amount. And the least amount, we're going to throw everything in our power at it, and we're going to get it paid off. And then we're going to go after the next one. We're going to pay the minimum payment plus everything we were paying on the first one. And then we're going to go to the third one and then the fourth one. Well, Roger, why not go after the highest interest one first? The whole idea is to eliminate the balances and create a snowball effect. Number one, you get that first credit card paid off. I guarantee you, you're going to feel motivated and ready to move on to the next one. And as you go up the chain, you're applying more and more money, and you're going to be much faster and much more effective. I've seen clients do this both ways. Trust me, lowest balance to highest balance works the best. Okay. So one thing I do need to mention, and I didn't mention it on the 401k, that is a loan, and you do have to pay it back. If not, it's going to be a distribution and you're going to be paying tax on it. So make sure that you pay it back. All right. Third thing you got to do is build some cash reserves. Now, I don't mean have a line of credit available. Okay. In fact, what I want you to do when you're doing your debt snowball, I want you to put $1,000 in the savings account and use that for emergencies, because I want you to stop using the credit cards, period. The quickest way out of a hole, stop digging. That's step one. So we're going to use that cash reserve, that $1,000 for emergencies. And we're going to build, once we get those credit cards paid down, we're going to start building our cash reserves. Now, if I've got a W-2 job, I want 3 to 6 months of personal expenses in the bank, in cash. If I don't have a W-2 job and I'm self-employed, I want 6 to 12 months. Now, you don't have to have that before you start, but you're building this over time. And it's not always going to be in a bank account. There'll be a small or amount of money in the bank account, but you're also going to want to put some of these into investments that you can liquidate quick. They're short term, 60 to 90 days, that kind of thing. All right. So that's it for today, gang. Remember, before you invest, count the cost, pay off your reductive debt, build cash reserves. Cash flow is king. This is the way to get to cash flow. This is the way to pave the road to great investing. Till the next time, Roger out.